Hello students, I think you have been following my lectures on a regular basis. So regularly we have been giving the video lectures on different topics in financial subjects, commerce subjects like management accounting, cost accounting, financial accounting, and general accounting, also basic accounting. So now today we'll be discussing under financial management one important chapter, that is working capital management, or other way the management of working capital. Why the term management? Management is to manage that particular working capital. You see that business long-term capital is required for your fixed asset purchase, just like land and building, plant and machinery, and your all other related fixed assets. Similarly, short-term capital required for your regular business activity. What are those things? You have to make payment of salary to your staff, make wages to your employees, and purchase of raw material. That is the basic component of your production process. So how to manage that cash? Frequently we have been discussing in other cases, the performance of a company depends upon the profitability of the organization. But can you tell that once there is a profit, they do have good liquidity? You can't tell that the issue, because you are selling the product. It is in credit sales, booking sales as your revenue part, and corresponding your debtors are increasing and you are booking the profit. But problem comes when you are trying to making the payment of your raw material purchase payment, or to make the payment of salary of your staff salary, you don't have cash in your hand. So that means working capital management basically is a cash management. That is, working capital interchangeably used your cash budget or cash flow. This is a short-term financing. You have to source some short-term payment source. So your short-term payment source, your short-term liability, that is the thing only. You have to make the payment for that. So now we'll understand that how that working capital cycle it continues, particularly for a manufacturing organizations. Same concept will be applicable for trading organizations also. Now let us understand what is working capital. Working capital concept, this is two concepts are there. One is gross working capital, where this gross working capital is nothing but your sum total of your current assets. Which are those current assets of a firm? Your cash itself, that means cash and bank balance, ready cash, short-term securities, your debtors, how debtors created, from credit sales debtors created, bills receivable, from that sales, credit sales only bill receivables created, and your stock. Stock means three components of your stocks may be. These stocks may be your finished good stocks, this may be your work in process stocks, so and your raw material stocks also. Sum total of your stocks, it is your the working capital. Why these are called the gross working capital? That means your short-term funds are blocked here. Suppose your cash holding that is there, whatever short-term securities you are holding, your short-term cash involvements there. Debtors, once you are selling the material on credit, it becomes your debtors. You will be receiving the money after some period. Bills receivable also linked up with your debtors, and your stock, as you have told, your raw material for production process cycle continuations, you have to hold some amount of or some quantity of your raw material, some quantity, some fund will be involved in your working process stage, and some portions will be your finished goods stock, because immediately after productions it will not go for sales, it will go in its own process. So this working capital nature is that those are the either case or to be converted within a accounting period. That means its nature in such a way, very short period, it will be converted into the cash, from debtors to cash, bills receivable to cash, and stock to cash. How it is coming, we will be going for some diagram. So generally its convertibility period within a period of generally one financial one accounting year. Now when we will be going for that, net working capital. Net working capital means current assets minus current liabilities. So current liability is also a source of working capital. Why? This is the thing for that your short-term assets, whatever is being created, it will be funded from your current liabilities. How these things? Suppose you understand that when you are allowing credit period to your debtors, at the same time you are enjoying credit period offered by your creditors. That means your debtors, some portions are being funded by your creditors. Take an example. Which amount in your stock, say raw material, say your WAP stage, say your finished goods, your creditors allowing the term for your raw material. So that means one portion of your stock is being funded by your creditors. Clear? Once way you are allowing credit period 2 years debtors, at the same time you are enjoying credit period offered by your creditors. That means why the concept of net working capital comes? Net working capital comes in this way, your current assets are being funded by current liabilities. Similarly, your bills payable, immediately you are not making the payment, you are getting the some period of time. So long you will be converting your stock to debtors and debtors to cash. Similarly process your bills payable, also they are giving some period so that you can convert your own process complete. Very interesting. This is a cycle, this is a chain reactions part. And outstanding liabilities also you are a source of working capital. Suppose whenever you are employing an employee, you are giving the payment for after 1 month, that terms, suppose December payment salary or wages you are making the last day of that December or 1st of January. So an employee who have been given service to your organizations for a whole month, that entire whole month you are utilizing their services. So that is also a compositions of your part of working capital. That's why this net working capital is coming current assets minus current liabilities, which portions neutralizes both against your current assets and current liabilities, living together, making a balance or net of both current assets and current liabilities. That is the net working capital. So this net working capital nature, how it is? It is expected to mature for payment within an accounting period. You see, generally you see 2 to 3 months they are allowing you the credit period, and you have to stop payment, you have to make 1 month, say. So generally these things will be maturing this within a period of one accounting period. So now this importance of working capital, why so important? So liquidity positions is very vital to run the show of your organizations. Profit is one thing, but at the same time, profit doesn't mean an yardstick to your liquidity of your organizations. You must to earn, you do have to earn profit, but at the same time you are to understand what is the liquidity positions of your organizations. You see, very interesting thing. If you see in your balance sheet part, how this short term your gross working capital concept develops. See, suppose you have started a business of rupees 1 lakh cash. This figure you are seeing. Once you are acquiring the raw material, your cash become converted to raw material. You see that nature of assets is getting changed. See, once you have purchased with that 1 lakh material, then your cash will not be in your hand. Mind it. It has been in the form other route, that is your raw material, right? So there every moment this getting changed. Once you have this material, you have put in the production process, your material in the produce stage. You see, production process, one stroke or one go, you cannot find the finished products. You see, one productions might be going in the different processes, process 1, process 2, process 3. So intermediate stage is the working process. So some material or some fund will be blocked here also. Then next questions, this working progress to come to your finished goods, that is sellable conditions, finished goods. You see, finished goods also immediately you cannot sell it. It will be also holding for some period. So that will be discussing for my subsequent video lecture. That is the how long it will be holding and what stage they will be holding for this thing. Those finished goods again to be converted into the sales or debtors, that is buyers, accounts receivable, that suppliers payment raw material, that is accounts payable, and here once you are converted into sales, credit sales, your accounts receivable comes. That accounts receivable, finally when you have recovered, you have come back to cash. That means our entire journey of any business organization, cash to start, and again you do your regular activities, all those things, again come back to cash. Again cash starts to raw material, to your work in progress, to your finished goods, to your sales, to your accounts receivable. Very interesting thing. Every moment your picture will change, your balance sheet positions also change. If you are to depending upon your stage by stage. If you daily basis also, if you take the balance sheet, your positions might be changing for this way. So this is the very important thing, particularly the how the use of resources in a manufacturing organizations. In case of trading organizations also, same concept will be there, but they are only directly trading material to your debtors and back to cash. So some intermediate process will not be there. So this is typically practical utilizations for an industrial organizations where you are producing the product and finishing the materials of goods. So this we understand. Now we will be going for that. Why we are talking about working capital management is nothing but the cash management. You see that every stage your cash conversion, ultimately you are to receive the cash and you are to make the payment of cash. You see that cash to your going out for short-term securities firm, cash to through sales debtors is coming, through sales it is coming receivable, and production process stock is there. So ultimately your cash, this cash is in different form of your short-term assets. Similarly, your liabilities also your creditors, bills payable, outstanding liability. This is also your liabilities. Ultimately you have to make good the payment by your cash only. So that's why working capital vis-a-vis cash management. Without managing the cash, your working capital management will not be fruitful and it will not be under your control. Why that is so? You are to make a cash budget beforehand. you see what payment you have to make, what volume of operations you will be doing, that you have to make in advance. Unnecessarily you can make just like a payment for that. Suppose to take an example, this is your working capital positions is there. You do have cash budget in beforehand, 1 year before. Suppose if you do not have your capital expenditure provisions in your cash budget, if you diverse your fund from your regular cash expenditure to capital payment, then definitely your shortage of working capital will be there. Just like your financial discipline is very, very vital. You cannot just say you are driving on the way, you have to go some route only. You cannot just like that you have a steering and you have a drive, then if you go this way, that way, accident will be there. So here also financial discipline is there. So now we'll be seeing for these things how we can make a cash management in your organization. So cash management is nothing but your cash budget. So cash budget, other portions will be discussing my subsequent lecture videos, but here now we will be understanding that what we have discussed here, gross working capital, net working capital, and your working capital formation cycle to conversion of one item of assets, that is cash, become to different forms of short-term assets. So that how it comes, that we have to understand for that. You see how this pro forma cash budget, why you have told this management of working capital, nothing but the management of cash. Management of cash, right? So this is the thing, pro forma cash budget, how we have to see that thing. This is the particulars. You see, suppose 3 months working capital, your cash budget you are making for these things, say October, November and December total, right? So you have to start with some cash, opening balance. You see, one thing you understand that in real world, particularly in your business organizations, here everything measured in monetary terms only. If you start to do anything, you have to start with cash only. Because operations to, this is financial terms only, no? So fund basis it will go. So you have to start with some opening balance in some particular October. Then your collections. Your cash will be added from your collections. As you have discussed earlier, collections from where? Either from your cash sales. Some collections will be there. Collections from debtors also. That credit sales you have made it, collections from debtors. Okay, so this is your total receipts for any month. Total A, opening balance of cash and your collections. This is the total amount. Now you are making from here, from this thing, say you are making payments October, November and December. What are the payments you are making? You are making for your cash purchase some amount. You are making your this thing payment to creditors, some payment you are making. Payment to creditors, salaries and wages, overdues, etc., any other overdues, tax liability, any payment you have to make it, that is the sum total of your payments, that is total B. So now you have to see that your closing balance, you have to find it. How you will get in closing balance? A minus B, some figure will come. So that is your the closing balance. This figure will come. Some figure. If you take an example, if you have opening balance of rupees 1000 rupees, you have paid cash sales, you have got your 1000 rupees, and your collects from debtors your 10,000 rupees. So how much your say collection from debtors, say 1 lakh. So 1,11,000, 1,11,000, and your cash purchases, say you have made it 50,000, payment to creditors 25,000, salaries and wages 10,000, overdues you have made, say 15,000. So your total B payment will become 75, 10, 85, 15, 1 lakh. So your closing balance will be 10,000. So this October month, whatever your closing balance cash, that will be the opening balance for your November month, that is 10,000 you have to start it for. Similar way, you have to make payment, some your November month, some receipts will come, total receipts will come, some figure. Similarly, November also some payment you are making this headwise, your total payments will be there. Here November month opening balance plus all these receipts, this will be your sum total A, this will be your sum total payment. So net balance also here it will come, and this balance will go again to your December month opening balance. December month also similarly you are receiving these payments, these receipts, sum total, some receipts will be there, and here December month also you have these payments also will be there, and sum total will be your this payment. So whatever your December month your total receipts will be there, that is total of A, your December month total payment, that will be your the net closing balance of your month of December end, which would become the opening balance of January for the next year. January next year. So this is the flow of your working capital. So why this cash budget, pro forma cash budget you have made in advance? You projected that this is my expected receipts. Accordingly, I will plan for that, which will be my payment for that. So if you have to make, you understand that here we have not made any capital payment. Suppose if your budget, if you want to make any capital payment, you have to make it. Then only you will be able to make the payment, actual payment. Otherwise what will happen? You will be mismanagement of your cash. Your short-term funding will be utilizing for your long-term fund. Suppose for your practical purpose, if you purchase a house, without you arrange the fund for that, what will happen? Your household expenditure shortage will be there. So for that purpose, some capital loan or something loan you have to make it, because any capital purchase, it will be going for a long period. So your household expenditure, some routine payment you have to make it a fund, and your long term payment, some fund will be there. So this is the whatever practical or applicable for your home or household cases, this is also similarly applicable in your business organization too. So that's why this cash budget is very much important for your working capital management concept. generally one concept you have told, no, je cut a coat according to your cloth. Whatever your fund arrangements are there, you have to plan for expenditure in the same basis. Without that, if you go haphazardly this way or that way, definitely some problem will be there, just like a driving concept way. So this is the basics of your working capital. So we'll be giving you the other video lectures in different dates in my subsequent videos. That is the practical problems of your working capital management, other area, how this working capital finance arranged, whatever way the implications of your working capital, all those practical problems we'll be discussing in my subsequent videos. If you think that my video lectures have some value additions to you, some concept develops for you, please do like and share as well as subscribe to my channel, so that I will be bringing all my videos subsequently. One thing I will be request to all, if you do have any query in your mind, please do give your query or your comment, so that I will be able to try to solve the thing. So आज के लिए इतना तक. We are ending the video here. Have a good day.